The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal.
How long will U.S. interest rates stay high? I'm Lisa Bernhard with Reuters, and I'm joined by Anna Rathbun. She's Chief Investment Officer at CBIZ Investment Advisory Services. And Anna, you are going to answer that question for us, aren't you? Because the Federal Reserve just concluded its two-day policy meeting and put out a statement on its current thoughts of the economy and where rates are headed. And what is your takeaway from that statement?
They did open a small window of possibility that they would be entertaining a rate cut at some point when they feel more confident. I know that doesn't give you a lot of confidence. What that means is that I think certainly they didn't change it today. I think March rate cut is out of the question. I think we're looking at either May or sometime in the summer when the Fed might entertain cutting rates. Now, all of this is going to be data dependent, and two things matter here. One is inflation data. It sounded like the Fed did not have full confidence that the inflation is going to not only go toward the target of 2%, but stay there. Because the last thing they want is to see a 2% inflation, and then they lower rates, and then for it to head back up. If there's any upward risk of inflation going up, they don't want a policy that's bouncing up and down. And supporting that sort of concern is labor data. So this Friday, we have labor data coming out, and so we'll see what January looked like. But certainly the skilled labor shortage that we have seen since the beginning of the pandemic, this is keeping wage pressure higher, and that is certainly inflationary. And lastly, there's always geopolitics that makes inflation a little bit of a tricky thing to forecast, because if you think about all the ships that are trying to go through Red Sea and now they can't, and so they have to go around the African continent, it just takes longer. So delivery times are longer and it's more costly to do that. So that's definitely also inflationary.
So Anna, let's drill down a little bit more on that 2% target of the Fed's. How do you get there when you have a consumer that's shown that they can power through these higher prices, that they can easily spend when inflation is still hovering around 3%?
Well, that's the hard part. 2 years ago when the Fed started to actually raise rates, inflation was at 9%. That's easy. Right now, really close to 2%, but not quite there, close but no cigar. That's much, much harder. And so this is, I wouldn't want to be in the Fed making these decisions because it's a really hard thing to do. And that is my point about the labor market. As long as the labor market stays strong and people have jobs and income streams, it looks like they're willing to accept that 3%, and it works against the Fed.
Stocks were down this morning and they stayed down after the Fed statement. Is this Fed driven? Is this earnings driven? What do you think?
Well, stocks were actually down even before the open, and a lot of that had to do with disappointing tech earnings calls. Now, if you think about what drove the markets to multiple consecutive days of record highs, like if you think about the S&P 500, it was really the Magnificent Sevens. So Magnificent Sevens drove the stock markets higher all through last year, and it's continuing to do so. And 5 of those 7 companies were reporting this week. So it was actually a really big week. Not only for tech, but also for the S&P 500. Now, there is a little bit of a pattern here. If you are a tech company that is disappointing market expectations when it comes to artificial intelligence, the market, it looks like, is willing to punish you. And that is what's happening to Google and AMD. Microsoft came out a little bit less harmed, but Google and AMD certainly is getting hit because of their perception that they're actually behind on the AI race. So last year, promise of AI took stocks really high, especially the tech stocks. This year, they're going to have to prove it.
Let's turn to good old-fashioned bricks and mortar retail and Walmart, the biggest of the bunch, which now looks like it's going to get even bigger. It announced today that it's going to expand or open 150 stores. This seems to fly in the face of everything it's been doing to try to compete with Amazon. What do you make of this about face?
So it looks like Walmart wants to be the store of the future, sort of the vanguard of modern shopping. What I mean by that is previous to online shopping and Amazon really coming into our lives, it was brick and mortar shopping. And then online shopping became a thing and really revved up through the pandemic. Post-pandemic, it looks like people want both. So what Walmart is trying to do is combine all of it and bring new meaning to what it means to be a superstore. Not only can you get mushrooms and furniture in the same store, you can also touch what you're about to buy, experience it. It looks like they're gonna even stage the furniture that they're selling, so you can sort of get an idea of how a bed might look in a room. And be able to actually go to a QR code and order it and send it to your house. So this is a combination of modern shopping that Walmart is trying to strike. According to their management, this has been successful. They've done a trial run and they feel confident enough to open more of these stores in the next 5 years.